Good morning, everyone. My name is Jamie Card. I am a partner in the financial services industry leader here at the Bonadio Group. Thank you for joining us today for our commercial loan documentation and TREBS webinar this morning. And then this is just our general disclaimer that the information that we are presenting today is the opinions of the presenter and not necessarily of the firm of our firm or her firm. So next, I would like to introduce you to our presenter today. Her name is Jennifer Chadwick. Jen is a partner and a member of the management committee at Lacey Katzen LLP, attorneys at law. Jen counsels financial institutions in commercial loan transactions, creditors' rights and compliance, and regulatory matters. We are excited to have her here today sharing her expertise as she discusses commercial loan trends in the market and loan documentation. Please welcome Jen.
Good morning, everybody. Welcome. I'm here today to talk to you about several things. We'll look at the overview today. We're talking about commercial loan trends in the market and how that has impacted commercial loan documentation and commercial loan financing in general. So we hope to go through today interest rate changes, C&I business asset-based lending trends, some commercial real estate lending trends, technology changes in loan documents, and forbearance agreements with a little bit of summary. I might touch on some fraud issues that have come up recently too that might be helpful for several people. So let's get going. The first thing I want to talk about, everybody probably has experienced or come across when dealing in any commercial lending scenarios, is that the changeover to from LIBOR to SOFR, the secured overnight finance rate. And this changeover was completed because people believed that LIBOR was being able to be manipulated. They thought SOFR was a more stable rate. And the Alternative Reference Rates Committee established by the Federal Reserve created SOFR, intending it to be a broad measure of the cost of borrowing cash overnight collateralized by the U.S. Treasury securities and in the repurchase agreement market. So what this has basically created in most of your national banks, several of your local banks that were using LIBOR or moving to LIBOR, was a changeover in 2022 to SOFR, which created a whole need to document and change documentation with respect to interest rate index. So you will be familiar with your notes and having them based on an index, whether that be the FHLB, whether that be the prime rate, or whether that be SOFR or LIBOR. So the base index, which might have a percentage above that index, that would create your interest rate that is charged to a borrower. So with those changes, all the LIBOR documentation, at least that I've dealt with the banks that I have worked with, created the ability to set another index from LIBOR, but there was a transition period of documentation that was required if you had a LIBOR rate, and of course a ton of explanation to the borrower from the bank on transitioning from LIBOR to SOFR. That transition occurred mostly in almost all banks from like 2021 through 2022. Some may have crept into the beginning of 2023, but basically in June of 2023, LIBOR, as we know it, was not being used as an index. And borrowers were transitioned with addendums to notes or agreements that created their transition to SOFR as their index rate. Some people were happy, some people were not happy based on how that impacted their rates or what they were comfortable with. Most of it, I think, was just being comfortable and people had understood LIBOR, how it worked. And then transitioning to something new is also always uncomfortable for people to get a hold of. And that really needed education from lenders and loan officers to explain to their borrower how it was going to impact the borrower's interest rates and documentation. The other change in interest rate that has significantly impacted not only the market for commercial loans, but the loan documentation for commercial loans is the rising rate and the prime rate. As all of you've probably experienced, and as I noted in my research, that 11 times from July 2022 to 23, the interest rate increased, causing significant changes in the marketplace for lending, impacting everything from commercial real estate, car loans, residential market, and those increases we thought at the beginning of this year would start to have the Fed would start to lower their rate and we would see some decreases. But as we are all well aware of, signs in the economy and the economy not slowing down in areas, but other signs in the economy where jobs growth is still pretty strong, but the GDP is low. So the Fed's kind of struggling right now, and it looks like we are not going to see the decreases in the Fed rate that we thought we would see in 2024. And we'll see what they do and what signs on the economy come up in their next meeting, and if we do end up getting any decreases in the Fed rate. So right now, most banks' prime rate is 8.5%, which, you know, when we were going from having commercial loans at 5% to jumping up to 3.5%, it creates a significant burden on the borrower. And it also creates a significant burden on the bank to assist their borrowers getting loans and remaining competitive in the market. Let's see. So as I discussed, the change in SOFR created the need to, review and change loan documentation. The other thing with SOFR that it was very difficult for lenders to adjust to was we had the idea of a LIBOR rates. We had the 1 month, the 3 month, the 6 month LIBORs that people were well aware of and used to. And then SOFR, when it first came in, had similar 1 month term rates that they were using. A lot of lenders probably over the last year and a half or so have developed a daily LIBOR to mirror kind of the LIBOR daily rate that changes. But that is not universal at a lot of lenders. And mostly your bigger lenders have tried to develop a daily SOFR rate for lines of credit and so forth to assist borrowers. Now, with a change in SOFR, I wanted to indicate to you that the documentation that's provided to most of your clients, if you're an accountant, or your customers, if you're a lender, that documentation does is similar to what the documentation for LIBOR did, which was provide for things that would happen if SOFR for some reason no longer is a viable option. So for instance, if SOFR became no longer available or it became not market acceptable. The bank has documentation in their notes and agreements that generally explain to the borrower that the bank might be able to set a different rate using a different index, and that's in the discretion of the bank. From a borrower's perspective, sometimes they try to negotiate that documentation to say it will be a fallback rate that they're most familiar with. So if SOFR somehow went away, maybe the borrower wants to try to negotiate what the index would be in those notes and that loan documentation. That's a tough haul, especially given the experience with LIBOR and conversion over, for lenders to try to adjust their documentation because they want the most flexibility if for some reason SOFR becomes a rate that's not marketable or a rate that can't be found. And so they try to keep that open-ended for the lender to be able to choose. But if I represent a borrower, I try to negotiate where that's a rate that's familiar or I know of, maybe a fallback rate to prime, maybe a fallback rate to FHLB rate. So, you know, keep that into consideration when you're looking at the loan documentation with respect to SOFR. Now, with the increase in interest rates and the prospect of the Federal Reserve, you know, cutting the federal fund rates, lenders and borrowers, when they're looking at their loan documentation, need to consider when they're granting loans, these possible changes. And that's always the case, just like with SOFR, and making sure that you can foresee potential changes and giving flexibility to a lender, or if you're a borrower, trying to pin down some cost certainty if you're a borrower on interest rates. That's also going to be the problem that we deal with when we have an interest rate environment that's going up significantly in the past 2 years prior to the, you know, in between 2022 and 2023, and then we expect to go down. So what we do in the loan documentation, if we're representing a lender, we're trying to put floors into the documentation that basically allow a lender to know that at no time my rate's going to go below this rate, given that the interest rate environment might be in the next couple of years a rate that declines. The borrower tries to negotiate a cap, and that's a very rare circumstance, again, that a bank is amenable to trying to give to them. But if you have kind of the ability from a market standpoint as a borrower to negotiate that, you may want to look at capping your rate. So if foresight was granted to borrowers 4 years ago, we might say to a borrower, it would have been great to have a cap on rates on a loan that you kept variable in 2020 and 21, which now is, you know, 4% higher, 5% higher than it was in, you know, in 20 or 2021. And now you're living to an interest rate and paying interest at a much higher rate, which strains your business and cash flow of your business. So that's the type of thing you try to negotiate as a borrower. The bank, on the other hand, wants the flexibility because they don't want to cap their rates in a market so that they are going to be losing money on the loan in the high interest rate environment. Okay, polling question number 1. What index has replaced LIBOR? Number 1, FHLB. Number 2, prime rate. And number 3, SOFR. Okay, CNI, business asset-based lending trends. As I discussed previously on the discussion about interest rate trends and how it impacts the loan documentation, the interest rate environment has impacted CNI lending significantly. Rate increases have impacted those loans coming up for renewal, lines of credit that are annually renewed, and new loans being made to borrowers. Where this happens to really impact a borrower is if you had a line of credit that's your working capital line of credit, and you're using that money, and you were, using that money at a rate of 5%, and now you're using that money at a rate of 9%, and that significantly burdens and hampers your ability cash flow wise, as you have to pay back and service that debt. We'll discuss later debt service coverage ratios, and this interest rate environment has particularly impacted the DSCR ratios, and really they have struggled, borrowers and banks, to address this in covenants that potentially could be blown in their loan documentation, because now the interest rate, at no fault of the borrower, now the debt that they're servicing has a much higher interest rate, and potentially could lead to blown covenant under the DSCR. The other problem that has happened is, generally speaking, a lot of lenders do term loans, and we have things like 5-year term loans based on a 20 or 30-year amortization. Now, in this situation, when you have with a balloon payment coming due at the end of 10 years, and your interest rate has shot up, you're looking, doubling your monthly payment for a term loan if you have to go refinance it. Right now, most lenders are dealing with this situation where they have term loans that are coming due. They're trying to renegotiate those term loans. The interest rate environment's very high. DSCR covenants are very close. So it's a struggle for the borrower and the bank to negotiate deals where they can, keep in compliance with their DSCR covenant, still maintain cash flow, and also have a reasonable interest rate document in terms of, from the bank's perspective, where they're not losing money on the deal. Significant increases for such loans, and banks also increase the competition depending on the size of the lender, the type of lender. You have some federal credit unions that have entered into the commercial loan market. You have, community lenders, community banks, regional banks, and national banks. And it's hard for smaller lenders, especially, to compete on that with this type of interest rate environment on renegotiating or refinancing, a better way to say it, these term loans that are now coming due with balloon payments. Lines of credit, LLCs tend to be based on variable rate with some type of floor, either whatever index that you're choosing. If it's a prime rate plus with a floor of 7, or if you have a SOFR rate with a floor, SOFR having a floor of 0 plus a percentage. These are to assure that the lender doesn't get economically out of whack with the interest rate environment. And lines of credit tend to also be, which is again something that historically wasn't an issue when you have a stable interest rate environment. Lines of credit tend to all be on demand in our market. Some have maturity dates, But typically working capital lines of credit are on-demand facilities, usually annually reviewed by a lender. And with this type of market, you can imagine as we annually review that the borrower is not too happy with their interest rate that might come up for a renewed line of credit. Meanwhile, the lender's trying to keep business and keep their borrower happy and is trying to work within those constraints to give an optimal interest rate to the borrower. So the interest rate environment being unstable, if you asked a lot of borrowers, they would say, oh, I have a line of credit at XYZ Bank. They don't even, typically a lot of them don't understand that that's an on-demand facility, can be called at any time, and that they're subject to potential interest rate increases based on that on-demand facility. So traditionally lenders try not to utilize that, but as the interest rate environment has changed, that has become a negotiating tool for certain for lenders to discuss how lines of credit and their interest rates are going to be going forward for borrowers. New loans, borrowers attempting to obtain new loans for purchase of equipment, the acquisition of a business, and or working capital have found it, tough in this environment to get good interest rates. And then lenders are trying to offer the best interest rates based on the strength of the borrower and the interest rate environment. What I have experienced representing lenders and borrowers is the utilization of financial covenants, covenants related to deposits, and increasing the financial reporting requirements in the loan documentation are ways lenders are ensuring that their loans are performing to justify the interest rates being charged. A couple of financial covenants that are frequently used in C&I lending to ensure the borrower is performing and are the fixed charge coverage ratio and the debt service coverage ratio. Fixed charge coverage ratio is utilized to measure the borrower's creditworthiness, and while there are variations to how this is measured, the basic formula is EBITDA to funded debt. There are some carve-outs often subtracted out of EBITDA, such as CapEx, cash, and taxes. In discussing, while I was preparing for this seminar, I discussed with all different lenders across the wide spectrum of lending that's offered in our community. And what was a common theme was that the fixed charge coverage ratio is often used to see how good of a credit stable it is, whether it's going to be a criticized credit, and that the DSCR is one that goes to more to pricing. Both of these covenants I have seen utilized much more frequently in deals that tended not to even have covenants at some point, but because of the pressures on the borrower and the pressures on the bank, the need to keep a credit stable, given the interest rate environment, has really influenced the use of these covenants in lending situations that normally we didn't really even worry about these. Debt service coverage is also utilized to measure borrowers' performance and basis for interest rate pricing. Some variation of EBITDA to interest with principal payments is used in a DSCR covenant. And as you can see, the debt service coverage ratio can be impacted by the amount of money and the charges of the borrower in their debt service. The covenants, what they can do and what they've been utilized to do and what they may do in the future, if you're a lender or if you're a borrower, is trigger an event of default that can do two things. Can put the borrower in a bad spot if they trigger an event of default and they have financial statements that need to be issued. There's going to need to be waivers given for their accountants in order to issue those financial statements without, in good stead. And then also for the bank, if there's financial covenants blown, they need to consider whether the appropriate interest rate is being charged on these loans, how it impacts the bank's credit and the borrower's credit standing, and whether there should be things such as later discussed, a forbearance agreement or other covenants or agreements put in place to make sure that the borrower can right size an event of default. There's twofold benefit of having significant deposits that I talk about and hear about there being a covenant in a lot of lending documentation, more so than what has happened in the past. I have found that a covenant tied to deposits on hand at the lender has been a covenant that has been almost universally now put in most lending documentation. Twofold benefits of that are the bank can make money usually off of deposits. And on the other side, if the loan goes bad and there's significant deposits held at the lending institution, no matter if there's a pledge in place or not, under the law, it's New York State law, there's the right to set off on deposits on hand. So this is what's been utilized a lot more. And when I first started practice, was not a covenant that you saw very often in documents, and it's now almost in every loan agreement or note that I review or prepare. The next thing I want to talk about is reporting, and that or the accountants certainly are well aware of in our webinar here, and the lenders. Traditionally, most lenders always had some type of annual reporting. You know, the copies of the filed tax returns with all schedules included. Maybe they had some interim balance sheets or monthly internally prepared financial statements of a borrower. I will say that financial reporting has stepped up significantly in this environment. You will now see way more detailed financial reporting, particularly if the bank does not or lender does not know the borrower as well as they think they do. But you will see monthly internal reporting, quarterly reviews, and also, you know, you might have things such as not only tax returns, but you're going to have reviewed financial statements, audited financial statements for some entities based on the entity. And so financial reporting has been significantly increased in most of the loan documentation that I have been preparing lately. And I think this, as I said, is to keep track of borrowers in this market and in this interest rate environment, to make sure that they're performing and that the bank can see things ahead of time that might be going and not in a great way for its borrower. Oh, as a side note, during the time period where we had PPP funds and ERC funds, if you were a lender, you were generally taking that money out of your, or having to separate that out from your reporting, or asked your borrower, or you looked at those funds outside of the borrowing. I think as of now, I think all the PPP and the ERC being the last that, all those funds and credits, I think, are now by the wayside, and borrowers going forward are going to not have those avenues to help with their cash flow in their business and keep them stable, which was the intent of both of those programs. But now financial reporting is going to look a little more like it did prior to the pandemic, where during the pandemic, when I was preparing loan documentation, we definitely had carve-outs for PPP and ERC. The other thing I would like to note that's impacted, it's impacted commercial lending for lenders and borrowers is typically financing was really, it was cheap of years, a few years ago. And so borrowers, if they were looking to acquire assets, were going to their lenders. They knew that, interest rates were reasonable, that they could afford it, that was the best deal. So that's where they went. Interestingly enough, over the last, I'd say, year and a half, because I represent borrowers too and corporations acquiring assets, I have found much more private financing involved. The private financing rates are equal to, and sometimes less than what a lender will be charging. So I think that's really impacted, the market for lenders, is that on acquisitions, a lot of times I found either a significant portion or all of it is being financed by the seller of the asset or the real estate. So that's impacted the need and market in terms of when they go to a lender. But I wanted just to note that I've seen that over the last year and a half as representing borrowers and acquiring assets. Let's see. Polling question 2. Which of the following is not a tool mentioned so far used by lenders to monitor a credit to assure repayment of loan? Use of financial covenants, use of financial reporting, use of a field audit. Okay, commercial real estate. This is the one I think in our area has probably been most impacted by not only the pandemic, but the interest rate environment. I think you will talk with most lenders and they feel either commercial real estate lending has been significantly slowed or they are really reviewing their commercial lending portfolio before lending new money, or also looking at their existing portfolio and reviewing it much more in depth. The growth, we have, a bunch of stuff kind of all coming together, I think, that has really impacted commercial real estate market here locally and nationally. The growth of e-commerce, remote work, along with the interest rate environment, all those have kind of come together to provide this really kind of a push down on commercial real estate. Online purchasing has steadily increased. In 2024, it is expected that 20.1% of retail sales will be online sales. Big box retailers and small retailers have struggled to compete as their business models include overhead costs and physical locations with rents and staff store. As anyone knows, your biggest liability is employees. That's your most costly, usually if you're a business of any business. And then you have your physical structure that's right up there as a cost and burden on the business. So e-commerce has generally significantly reduces the need for physical locations. Warehouse can be outside of that, and also tends to reduce the need for staffing, which puts them on a better marketplace against your retail physical location stores. As reported in Modern Retail in December 2023, there was a 30% increase in company bankruptcy filings in 2023. You have such staples as Bed Bath & Beyond, David's Bridal, Rite Aid, Party City, and last week Express has filed for bankruptcy protection. Another retail restaurant, which there's a bunch of them that have filed, but the ones that are, you know, really important in this retail chain are the ones that you see in strip malls and mall locations. Another one that's right on the brink right now is Red Lobster. They're looking to restructure their expensive leases, and they're looking at filing just to be able to negotiate. I know they're apparently looking for a purchaser right now, which they might have one. But I mean, I read about these daily now, these stores that are now filing bankruptcy. This impacts obviously the commercial real estate market, because if you have an anchor tenant that is filing a bankruptcy and no longer in existence, and you're the landlord and you got a loan that needs to be paid, that's a problem. So, you know, financing any type of commercial development is really become a struggle. In addition, if you know, as we're all aware, we all probably do this to some extent in all our current places of employment. There's now hybrid and remote work situations that are available. So, you know, businesses that tended to fill up office space now might need like a quarter of the space or half of the space, or they're going to be down 20% of the space needs. So as leases come up for renewal, now businesses are going to be looking at, well, do I really need all that space, and trying to negotiate smaller spaces with their landlords. Forbes Advisor reported in June of 23, 12.7% of the U.S. workforce worked remotely, while 28.2% were hybrid. The downsizing of space, and we can just look in the city of Rochester, the empty office space in downtown Rochester or any of our downtowns is very significant. And it's really put pressure on that business in terms of being able for the lenders that are financing to that. If their landlords don't have tenants, and tenants, then they're not paying rent, and then the landlord's not paying the loan. So that has been taken into consideration when they're looking for any type of new financing or refinancing on these retail spaces. So how are lenders looking at these now? What are they doing? What can they do in their documentation that can help them out? Well, what they can do is, I've seen more DSCR covenants in real estate transactions. I've seen more financing reporting in these financial reporting in these real estate transactions. I've seen more looking at the actual leases. When do they renew? Who's the actual tenant? What's the financial stability of the tenant? Is there any security that the tenant, if they bag out, if they're not able to finish the lease, is there any security provided for rent payments? What type of space is it? Can it be rented if a tenant gets is no longer able to pay or is no longer utilizing the space? So lenders are digging in and deep diving into the actual leases way more than they were before. Also, I discussed with several lenders, that appraisals are also another thing that is really being dug into by the lenders. A lot of appraisals will have like if-come type scenarios where, this space can be utilized if they find a tenant. Well, if-come isn't good to rely on. And so appraisals are now starting to really be looked at in depth, so that the bank can assure that there's really that value in the premises that they're lending on. The other thing is, again, utilizing deposits. on utilizing deposits that the real estate entity has in the bank, again, to offset interest rates that are being offered to lenders, and also securing payment that they have the deposits on hand to maybe offset payments that have gone past due. Those types of things have also been put into documentation. Okay, polling question 3. Which of the following is not a retailer who filed bankruptcy in the past 3 years? 1, Party City. 2, Red Lobster. 3, Bed Bath & Beyond. Another part of the discussion I wanted to have with respect to real estate lending is that in certain scenarios, what has happened is if we have a construction loan that's going out to develop a plaza, to develop a mixed-use facility or a warehouse, what has been happening is that, generally speaking, in that development phase, whether that be 6, 9, 12 months, there was a variable interest rate offered. Given the market changes, the interest rate changes, what has happened is what some lenders are tending to do now is that in that permanent phase, they're not committing to an interest rate per se. They have an adjustable interest rate that will be set at the time of permanent refinancing. And even some lenders have taken that even further and say that we're only going to lend up to a certain period amount of money, and it will be determined at that permanent interest rate based on a covenant, either a DSCR or a review of the project itself. So that initially the loan, they might have been contemplating lending permanently $4 million at the end of construction. That gets reduced down to $3 million or $3.5 million based on hitting certain covenants or review of the project and the interest rate environment at that time, and whether the borrower will be able to afford making those payments going forward. Just a couple of years ago, we were committing to interest rates after the variable rate. Now we're not committing to them, and in some instances, we're not even committing to the money that we're letting out the door. So just that's been discussions with a lot of lenders. Okay. All right, technology changes in loan documentation. I thought this would be very helpful for both lenders and borrowers and accountants to know that there's a significant push. Part of it because of the pandemic, to go to, e-sign documentation. What's valid, what's not valid, how far should we push e-sign documentation? All this is changing on a monthly, daily basis. The creation of electronic signatures and confirmation of their enforceability need to be compliant with state and federal law. Lenders started utilizing these tools heavily during the pandemic. PPP loans tended to all be DocuSign documents. Lenders are increasingly trying to send customers and borrowers electronically generated documents for electronic signing. Most lenders still look to have original wet signatures for larger credit facilities. Lenders use electronic signatures to document and disperse the PP loans that I discussed previously. As lenders get more comfortable with the ability to enforce loans documented with electronic signatures, and the courts rule on the validity of those documents, assuming courts uphold enforceability of e-sign loan documents. And I will tell you this, although there's case law under New York State, the Electronic Records and Signatures Act, and then e-sign Act federally, judges get they get the best evidence rule involved. They love original signatures on things. So having judges and the courts change as the laws change has been kind of a slow pull. So that's why a lot of lenders still want to have original wet signatures. Already in consumer lending, a significant amount of consumer loan documentation is executed with electronic signatures, with most still obtaining wet signatures on any mortgages and notes. I will tell you that under the Electronic Signature Records Act and the e-sign Act, you could have a valid signature on a mortgage, but previously counties would not allow anything but original signatures, original notarized signatures to be recorded in the clerk's office. That started to change pre-pandemic, heavily during the pandemic, as courts now are going to a lot of submissions on filings electronically and submission on recording documents electronically. So documents that need to be recorded in the county's clerk's office to become effective, such as mortgages, as I said, had always needed wet signatures. Each county may have its own procedures to accept electronic signatures in New York, which is problematic. From county to county, you might have the ability to submit a non-wet signature, an original though, it has to be compliant still with New York State Electronic Signature and Records Act. You might be able to send those documents into the court through what they call a submitter in Monroe County, not have an original signature and have it recorded. But each county might have different rules. So in Monroe County, they require the document to be e-filed through a registered submitter. There are several agencies, title companies and so forth that are registered submitters. The registered submitter then will be a person that asks you or might require certain documentation from you, and they may require a wet signature or a representation that you have one before they e-file it. A typical one like CSC, they don't require a representation that you have the original signature. They require that you represent that it's compliant with the Electronic Signatures Act and compliant with the recording rules in Monroe County. So then you could submit an electronically signed document for recording, have it recorded, and not have an original signature. But you have to check with who your submitter is, what documentation they want, and representations that you're making under your agreement with them as to whether you have original wet signatures in hand. I've had submitters require representation that there's original wet signatures on hand, and I've had others that do not require it. The last thing that you have to worry about, which is what I talked about before, are judges in the court. So if we went to go sue on a mortgage and we didn't have the original in our wet signature in our hand, would the judge accept an electronic signature? If compliant with New York State federal law, they should accept that as the original. It's just another level to explain to a judge in a court to get that submitted. Sometimes in like a foreclosure proceeding where that gets electronically submitted, a judge doesn't ask hide or hair about where the actual original is, but sometimes it comes up as an issue, and then you have to prove that you have, a document that's compliant with the law, that's the best evidence. There was no wet signature per se, and that is compliant and is the quote original, even though electronic signature. And so the mortgage should be, that form mortgage should be used by the judge to enforce its terms. Complications come because there's certain documents that fall outside of the Electronic Signatures Act in New York and e-sign Act federally, and that's the note. So if there is a significant dollar amount being lent on a note, generally speaking, I'm still recommending using a wet signature on a note because that falls under the UCC. There's still the ability under state law to have electronic signature on that document be acceptable. It has to meet with certain requirements. Just in terms of not having to jump that hurdle, also, if all the lenders and borrowers out there know, if a loan is sold or transferred, it's often asked by the person purchasing that note that they have an original with an allonge assignment of the note over to the next lender, and they usually ask for that document still as part of selling off or transferring a loan. I'm not saying that they're not enforceable. I'm just saying they fall outside they fall outside those Electronic Signature Records Act and e-sign, and it falls into the UCC and then a state law, which puts burdens on whether an electronic signature can be accepted on a note. And it's tough to convince sometimes judges and attorneys on the other side that that is the best evidence, and the note should be enforced even without a wet signature. Oh, as a side note, things like wills, trusts, POAs, and healthcare proxies, generally things that are of that nature need still wet signatures in New York State. So with respect to the note, I just want to make one comment. I have in the materials, it states unless an electronic version of such record is created, stored, or transferred pursuant to this article in a manner that allows for the existence of only one unique, identifiable, and unalterable version, which cannot be copied except in a form that is readily identifiable as a copy, that note signature might not be upheld if it's in electronic form. So you can imagine proving that in a court to a judge that that exists. Generally speaking, what you need to do if you have an electronic signature program if you're a lender, even if you're using an electronic signature program to enforce contracts as an accounting firm or as a business, what you need to make sure of is that your vendor that's providing you with electronic document ability, such as a DocuSign, is able and is compliant with the state and federal laws for electronic signatures, so that you could go back and prove the things that I just stated, which is you got to be able to make sure that it's unalterable, that it's unique, that it can be identified, and that if there's a copy made, you can be made sure that it says that it's a copy and it's not the original. So, vendors such as DocuSign, I found, have been able to assist and assure their customers that they can create valid electronically signed documentation and that they're compliant with the law. But you got to look at that and make sure that you're utilizing services that will, at the end of the day, be able to provide you support and backup and to enforce a electronic signed document. What law governs notes? Polling question 4. What law governs notes? E-Sign Act, Electronic Records and Signatures Act, or 3, the UCC. All right, our next wonderful topic, and we'll put it together with a summary, are forbearance agreements. As a result of what we've discussed all along here, interest rate changes, market changes, less cash in the market for businesses from PPP and ERC, all this has put pressure on borrowers. There are loans now and loans that are contemplated in the future that may breach covenants or experience an event of default. How do we kind of bridge the gap and help the borrower right the ship while keeping in compliance and providing the bank with assurance that it's going to get paid, and potentially keep the criticized type credit still making money for the lender, but allowing the borrower to right the ship to be able to bring it back to where it was prior to an event of default. So what we've utilized in the past, and most banks and lenders will do some form of this. How formal they are with respect to actually documenting it is a whole other thing. But I recommend documenting any type of waiver, forbearance in a written agreement, that you provide the borrower with defined goals, such as meeting certain covenants, having certain requirements for reporting. You might be asking for additional collateral. You might be asking for additional deposits. And then you state as a lender whether you're going to be charging a fee for granting such a forbearance type agreement, or if interest rates are going to go up during this forbearance period. So it's definitely a situation where you have to spell out the terms, make sure both parties understand what the requirements are, what the expectations are, and that what the monitoring will be, and how we actually get out of the forbearance period and what the loan looks like as it's performing. So these agreements I've utilized a lot recently, and it assists the lender in that there might be loans that were garnering low interest rates but not performing. You can now adjust that dynamic, gather market interest rates, hopefully get the loan performing and going forward. And it helps the borrower, and they don't have to go out in an interest rate environment that might even be higher, more than likely quite a bit higher, out on the market with a non-performing loan. So I highly recommend to banks and to borrowers to make sure that if there is an event of default, and if there is a path to righting the ship and curing that event of default, that's documented in an agreement, that the terms are clear on what it looks like in terms of what performing is and what will happen during this time period that the borrower is able to perform, that's spelled out. Okay, now in summary, lenders, I think this market is very interesting. I find it very hard on the lenders. I find it very hard on the borrowers. And depending on what side I am, often is what hat I'm wearing. I get very frustrated on each side, but it's an interesting time period. There are opportunities for growth. I didn't mention that there are opportunities, warehousing, commercial space that's mixed use. There's often, like in Buffalo and now starting in Rochester, that's become a more favorable dynamic where you have residential, retail, and some office all combined. I think that's an interesting area that's experiencing, growth and looks better to some lenders and looks more attractive to borrowers. But it's definitely a challenging time for both lenders and borrowers. And for me as a person that's documenting the transaction, I think it's most important that we're clear on what the expectations are from both sides, what the obligations are from both sides, and that we put that in the documentation so that people have a clear path on how a loan will look like and what's non-performance, what's performance, and what the expectations are. So I thank you guys for your time. If you have any questions, please feel free to reach out to me at my email address, jchadwick@laceykatzen.com. I'd be happy to assist anybody.
Thank you so much, Jennifer. That presentation was fantastic, very informative. We hope that you all found this information session informative. You will receive the presentation materials within 2 weeks of today's webinar. If you do have any questions, as Jennifer alluded to, please feel free to reach out to her or myself or your contact here at the Bonadio Group. Lastly, please keep an eye open for details regarding 2 upcoming webinar sessions we're having in June. One regarding AI in banking and a second one regarding CRA and business lending role. Thank you so much and have a good day.